They keep telling you the same story. Work hard, save money, be patient, climb step by step, and the system will reward effort. But if that were really true, we wouldn't be seeing wealth rush upward this quickly, faster than ever in modern history, and we wouldn't live in an economy where the rich level up every decade while most people are told to tighten their belts forever. Look at the scale of the shift. In the late 1980s and early 1990s, the wealthiest 1% of Americans controlled roughly the bottom 20% of national wealth. Today, their share is about 32%. That doesn't happen because one group suddenly became twice as brilliant or twice as hardworking. It happens because the rules of the game were quietly rewritten. Once you see the mechanics, you stop calling it bad luck or market forces. You call it what it is, a system engineered to pull value upward. This is not a moral lecture about individuals. It's a map of the machine. And you are inside it. Everything starts with money creation. Since 1971, when Nixon cut the dollar loose from gold, governments gained a superpower. They could create money without a hard limit. And over time, they used that power on a massive scale, trillions created through policy, credit expansion, and central bank intervention. But here's the trick. That new money did not flow evenly through society. It entered the economy through finance first, through banks, markets, and asset buyers, through the plumbing of the system. So instead of lifting everyone's income, it lifted the price of what wealthy people already owned. Stocks, bonds, real estate, every kind of investment asset. If you owned assets in the 1980s, you were on an escalator going up. Your house multiplied in value, your portfolio ballooned. Investment property became a wealth engine. But if all you owned was your labor, your hours, your energy, your skills, you were on a staircase moving slowly, while prices ran ahead of you. From 1980 to 2019 or 2020, worker productivity rose about 70%. Corporate profits rose more than 400%, but real wages, adjusted for inflation, rose only about 10%. Read that again. You became roughly 70% more productive than your parents. You created dramatically more value for the economy. But your paycheck, in real terms, almost stood still. So where did the missing value go? Upward. To shareholders, to executives, to owners of capital. The system didn't break. It performed exactly as redesigned. Here's a clean example of how the ladder was rebuilt. In the 1980s, the average CEO made about 40 times the average worker. Today, that ratio is around 300 to 350 times. That gap didn't expand because CEOs became 10 times better humans. It expanded because their compensation shifted from salary to stock options. And in a world where assets inflate faster than wages, stock-based pay becomes a rocket. Money printing, buybacks, and financial engineering push equity values higher and higher. So executives ride the wave. Meanwhile, the people producing the goods and services stay on wages that barely outrun inflation. Two classes inside the same company. One paid in assets that compound. One paid in wages that crawl. Under modern monetary policy, assets always win. Now we hit the second engine, credit. Credit is not neutral. It is priced by your position in the wealth hierarchy. If you're wealthy, you borrow at around 3%. If you're poor, you borrow at 23%. That single difference compounds over years. It builds dynasties on one side and a treadmill on the other. If you have assets, banks treat you like a safe bet. They offer low-rate mortgages, business loans, portfolio leverage. You borrow cheap money, buy appreciating assets, and rising prices pay off the debt while you keep the upside. Debt becomes a tool for building wealth. But if you don't have assets, credit flips on you. You need a car, you borrow at 12%. You need an emergency repair, use a card at 23%. You need education, student loans follow you for decades. Every borrowing decision costs you a premium just for being at the bottom. Make it concrete. A wealthy borrower takes $1 million at 3% to buy investment property. Annual interest is about $30,000. Property appreciation at 5% is about $50,000. They net roughly $20,000 a year just for borrowing. A poor borrower takes $20,000 on credit cards at 23%. Annual interest is about $4,600, and they're not buying an appreciating asset. They're buying survival, groceries, repairs, bills, things that vanish. So the rich are paid to borrow, the poor are drained to borrow. That isn't a coincidence. It's a design feature. Then comes the third engine, taxes. Tax policy is framed as fairness, but the structure reveals the intent. Tax labor hard, tax wealth lightly. If you earn a paycheck, you pay income tax. federal, state, local, it stacks up fast. For many workers, that's around 30%. But if you earn through investments, you pay capital gains. That tops out around 20%. Already, you're paying less. And for the ultra-rich, even that often disappears through engineered strategies. One classic strategy is buy, borrow, die. You own 100 million in stocks, you don't sell. Instead, you borrow against them. Banks lend you 20 million at low interest because your shares are collateral. You live on borrowed money. Borrowed money isn't taxable, so you pay zero income tax and zero capital gains tax. When you die, your heirs inherit the stock with a stepped-up basis. The purchase price resets to current value. They can sell, pay little or no tax, and use the proceeds to close the loans. The fortune crosses generations almost untouched. Meanwhile, you pay tax on every dollar you earn. You can't offshore your labor. You can't shelter your wage. You can't step up the basis of your paycheck. So labor becomes the easiest target. Wealth becomes the protected class. None of this is new. We've watched this movie before. Gilded Age America, 1870 to 1900, was dominated by a tiny group of industrialists. Their wealth was so concentrated they controlled infrastructure itself, oil, steel, banking, railroads. Most people worked under brutal conditions. Low pay, dangerous factories, child labor, no minimum wage, no overtime, no safety standards. When workers tried to organize, private armies broke strikes. That wasn't free competition. That was feudal power wearing factory clothes. It took decades of conflict and intervention to slow that concentration. And for a while, the machine reversed. From 1945 to 1980, inequality fell. The middle class grew. Wages tracked productivity, but then the gears turned again. Starting around 1980, policy shifted to favor capital over labor. Tax cuts for the wealthy, anti-union pressure, deregulation of finance, globalization that offshored jobs, concentration resumed. We're back near Gilded Age levels. Different tools, same outcome. If structural design is the slow engine, crises are the turbo boost. 2008 made that obvious. Banks gambled. The system cracked. Ordinary people lost homes, jobs, savings, and the people who caused it were rescued. Trillions were printed and directed into finance. Wall Street used cheap capital to buy foreclosed homes for pennies. Institutions became landlords of the people who lost everything. Then 2020 repeated the logic. Roughly $6 trillion was created. Markets recovered instantly because central banks flooded assets. Owners won, workers absorbed layoffs, closures, rent stress, and inflation. Every crisis follows the same script. Something breaks, the government prints. That money flows upward. Assets recover. Wages don't. Now add the math of compounding. If you start with $1 million and earn 8% annually, after 10 years you have about $2.1 million. After 20 years, about $4.6 million. After 30 years, about $10 million. You did nothing special. You owned assets and let them compound. But if you start with zero, your income is linear. You work, you get paid, you stop, the money stops. There is no compounding. And inflation eats what you save. That's why starting position matters more than effort in a compounding system. Inflation makes it worse because it inflates asset prices first. Owners win. Non-owners fall behind. Housing proves it. In 1980, median home price was about $64,000, median income about $21,000. A house cost around 3 times annual income. Today, median home price is over $400,000, income around $75,000. A house costs more than 5 times income. Rates may be lower now, but prices are so high that even at 4% the payment crushes. You pay longer, you build equity slower. Owners watch wealth inflate. Put the machine together and you see the outcome is already built in. Assets inflate faster than wages year after year, so owners gain ground while workers tread water. Cheat credit flows toward the wealthy because they look safe on paper and have collateral to prove it. Expensive credit, meanwhile, traps the poor because the system prices risk into their lives. Taxes shield capital and target labor, so wealth keeps more of what it earns while paychecks get clipped first. Crises don't reset this machine. They accelerate it, pushing fresh money upward while the bottom absorbs the shock. Compounding then magnifies every early advantage, turning small head starts into permanent distance, and inflation prices out newcomers because assets rise first and wages chase behind. So if you start with capital, you ride a rising tide that keeps lifting you. If you start with only labor, you're fighting the current just to stay in place. And because capital owners influence the rules, the politics, and the narratives, you're told inequality is about merit. But that story collapses once you see the design. Until you recognize the machine, you'll keep being asked to play a game you were never meant to win. If this gave you a new lens, subscribe. Chrono Finance is where history explains the present, and the present warns the future.